Two things. One, don't look at the title on your business card. Just think about yourself as a venture capitalist. Find, decide, win, help, and exit. And then the second one, exceptional companies deserve exceptions.
Nikhil, I am so excited for this. We did this like 7 years ago remotely, and so to have you in person is such a treat for me. Thank you so much for joining me.
Thanks so much for having me, man. Yeah, it's fun to have dug into the chats to see when we first connected. It was January of 2016. I cold outbound messaged you on Facebook Messenger, which we realized, which is hilarious. And it's amazing to see where you've come since then.
I mean, I look about 25 years older. It's the venture game is having its effect on me. I think I'd love to start on is I think we change how we invest so much in time. And if you were able to cool yourself the night before your first day investing, what would you advise yourself on that call?
Two things. One is actually a piece of advice one of my partners at Shasta gave me pretty early on, like probably in the first couple months, which is don't look at the title on your business card, which at the time was associate at Shasta Ventures. Just think about yourself as a venture capitalist and do as venture capitalists do, which is find, decide, win, help, and exit. So the 5 components of our day-to-day job in venture. And that advice, I think, was really profound. It sort of unleashed me, and it's the advice I give young people in venture today, which is, again, don't look at your title, don't think about exactly what the role is, just think about yourself as a VC, and I think you'll be better off for that. And then the second one that came to mind is exceptional companies deserve exceptions, and it's a mantra that I've tried to always have in my venture career, which is, yes, you have this model of how you want to invest, this dream idea of portfolio construction and the profile of company that you're looking for. But it's so often the ones that you consider an exception for, the ones that just blow you away, that feel like outliers, that end up being the ones. And so I've always tried to have that in the back of my head, which is at the end of the day, all of what we're doing in our job is searching for the outliers and the truly exceptional companies.
So I do just have to unpack both, actually. The first one you said there about kind of do your job as a venture capitalist, don't worry about the title.
Yeah.
So often founders are told, sorry, I'm going here, but I'm interested to hear your thoughts. Don't speak to the associates. Like, it's the GPs who make the decisions. And I'll be honest, I say that too, especially at growth. We don't have time for spinning cycles on associates. Like, just go to the GPs. I can introduce you to them. Do you agree with the advice on just go to the GPs?
I think it's case by case dependent. And there are so many folks who've grown up in the industry to become incredible investors who started off at the bottom of the ladder at a firm. And so you just don't know who those people will be. I think that you're better off as a founder judging based on the actual conversation you have, which sometimes may be a lot better with the youngest person on the team versus the managing partner of the firm. And sometimes it won't be. I always give people a chance, whether it's the founders who, come in through not that warm of an introduction or purely cold. I always try to review what they're saying, and I'll quickly write an email back saying, not interested, thanks, if it truly is not a fit. But I've always kept that mentality. I started at Insight Partners in New York, where I was bottom of the ladder as a summer intern and then an analyst. And so I obviously have bias on this dimension. But I do think that there are people who are really young in our business who are really thoughtful, and that a conversation with them might actually lead to some learning for you as a founder, and it may even lead to an investment, as it's done for me several times in my career on the venture side.
No, I often find actually that they're some of the most researched and thoughtful because they've had the time to actually map out a space, and they can actually provide a lot of value back to founders where they haven't had the time to do competitive analysis on pricing and everything in between. So totally get you there. On the exceptional companies deserve exceptions. Is there one company or a situation that just most stands out to you? You've invested in the Canvas of the world and many other great companies. Is there one where that was very much the case?
Yeah, I mean, look, I think the Canva investment for us at Shasta was an exception on so many different dimensions. And so it's obviously the one that stands out for me personally. The company was based in Sydney, Australia. It was raising a convertible note at a $25 million valuation cap. It had no revenue yet. It had a bunch of early signs of product market fit, actually, like, several 100,000 monthly active users of Canva who were using the product really aggressively. It was growing 30 to 40% every month. It broke a lot of the traditional rules. And so, we thankfully decided to make that investment. But there were all sorts of reasons to let it go.
Dude, I mean, just for the context, they're like married couple as co-founders who are fantastic.
Well, they were not married then.
Love them both, but like a couple as co-founders is a contentious one.
Absolutely.
Non-technical.
Yep.
In Sydney, Australia.
Yep.
Not a like stellar who's who of like seed investors before because it was so early.
Yep.
Dude, it was like I look at that and I love Cliff and Mel, but I don't know if I would have done it.
When you dug beneath the surface on what was actually happening in people using the product, you could see what I just described, which is, wow, there's 100,000 people using this every month who are creating 300,000 to 400,000 designs on Canva every month. Those folks, it was about 6 months in after the product had launched, and you could see that those folks, sort of their cohort retention in the first 6 cohorts looked very strong. It looked like it was flatlining of creators who just were using Canva on a very regular basis to design things. It was also fragmented usage. It wasn't just Facebook posts and infographics and social media content. It was also pitch decks. It was also posters. It was a lot of different types of media, and it was growing completely organically. The SEO thing hadn't yet been figured out, but it was still just growing through word of mouth from people using Canva, posting Canvas out in the wild, and other people discovering Canva as a result. And so all of those characteristics gave it some early signs of product market fit. If you only stared at that, you could see that there was something really special here. And if you sort of put away the noise of everything you just described, I think what you would have seen is a really interesting product that has strong early signs of product market fit.
I think we actually really underestimate don't laugh, but like the momentous weight of product market fit. Like once you have that, so much else goes away.
Yeah.
And don't get me wrong, you need to find the next stage of product market fit, but so few actually get that. As a pre-seed investor today and a seed investor, I don't know about you, but like so many don't even get there to the earliest signs. We've seen this interesting reversion away. In the last few years, it was like scaled funds, AUM. Wow, they've raised big funds. Last 6 months or 12 months, we've seen this constraining fund size and this kind of applauding of it, which I'm not saying is right or wrong. It's just funny, the reversion. How do you think about the small fund versus big fund for early stage venture, Nikhil?
I'm very biased here because at Footwork, we're still investing our first fund. It's a $175 million fund. And my firm belief in my bones is that small funds outperform bigger funds. It is incredibly difficult to have a 5x net return on a $1 billion plus fund. I think there's incredibly few of those funds in the history of venture.
We actually did the maths with Jason Lampkin the other day, which is if you have a $500 million fund and you want to do a 6x on it, you then need, if you have a 10% holding, $30 billion of enterprise.
That's 6x gross.
Yeah.
Not net of carried interest and fees that LPs pay. And so 5x actually net is a higher threshold than that. Yeah. It's more than it's at least one Canva in that size fund.
With 10%.
With 10%.
That's high. And it's every fund. You need that on a 2-year cycle.
Exactly. And there's so few companies that get to that stage. And so when you do that math, it just makes sense to me that small funds are going to outperform big funds on average.
But do you think anyone disagrees with you? Because obviously not. Of course you're right. So it's easier to make money on small funds.
Yeah, but then people have made decisions and taken actions that would suggest that they don't believe in it. If the purpose of what you're trying to achieve as a venture capitalist is maximizing returns, therefore sort of maximizing carried interest,
well, isn't this a misalignment between GPs and LPs, though, which is that actually absolutely. If you have a $400 million fund and you 3x it, which I'm not saying is easy by any means, that's hard to do, but it's much better than 5xing or 6xing or 7xing a $50 million fund.
100%. And that's part of the issue, I think, which is if there was true alignment, it would be about maximizing the multiple. And that's certainly how we think about it at Footwork.
What do you think happens then? Like, do you think that all of these funds downsize and say, you know what, we actually are returning back to an optimization on returns?
I think a handful will. And I think there'll be a very smart handful that will. But it's a really difficult and painful decision to do that.
Also, your team is based around the fees that you have, and that's difficult to manage as well.
Although I would say most venture firms have plenty of fees to cover the team and more, especially at that fund size scale. But more than that, I think there's this narrative in the industry, right, about how big your fund size is and how much AUM you have. And so it's really hard to go, I think, from even a brand and reputation standpoint in the market, from having a $2 billion fund to having a $400 million fund. And the handful of firms that have actually made that type of decision historically, I think, have been, some of them have been really better off for it.
The thing I feel quite constrained on, and I'm envious of the larger funds for, is their ability to be less price sensitive. And what I mean by that is their ownership focus, very much like I'm sure both of us are. Yeah. But whether it's 3 million or 1.5, they don't really care as long as they get their 15 or 10%, whatever that is. And so founders are like, listen, Harry, I love you, but why would I take your offer, which is way less, than their offer, which is much more? And so our ability to pay up is significantly reduced if we want the same level of diversification. I find that challenging.
It is certainly a challenge, and it's something I think all of us have faced against the big multi-stage firms with billion-dollar-plus funds. What I'll say about that, and what I try to explain to founders, is I think that that's actually a misalignment between founders and these types of investors, which is oftentimes in the founder's best interest is actually taking less money, being more constrained in the early days to find product market fit, as we were talking about earlier, given just how big of a inflection that is. I mean, how many times have you seen a big early stage financing yield to nothing for the founders, nothing for the company? I just think there's very few of those rounds that actually have worked out historically.
Very few.
And so
it's funny, I'm going to get in trouble for this, but my worst, and the reason I think the show does better today than ever is because you probably open up and have more people hate me than before. But my worst performing, and I've done 150 investments now, the worst performing ones are always the stellar VP that comes out of the stellar company and raises 10 on 40 as the pre-seed. Yeah. They are always the ones which slowly meander to either a bad acqui-hire or nothing. Do you find that too?
Yeah. We don't do those types of rounds, and we're not set up to do those types of rounds. So actually, in a strange way, I really like the constraint of our fund size. I actually think it forces us to make better decisions, and I think there's a laziness and a lack of great decision making that can come from having a bigger fund, in the same way that it can come from having too much capital in the early days as a company.
I agree with that. When you think about, bluntly, the argument with founders, or not the argument, but the debate, when they have a multi-stage fund and a seed fund, and they say, hey, these are our options, how do you actually advise them on taking the money? And they have much more money available to them from the larger funds. I guess my question is it always better to take the smaller round, do you think?
Look, I think it is dependent on the investor, of course. So that the variables that would go into my thinking are the firm, the partner at said firm, and sort of the match of that to the type of business, and the capital match to the type of business. Because there are some companies that actually do need more capital in the early days and that will benefit from that. And so I struggle to have a general piece of advice on that front. But of course, based on Footwork being a stage specialist firm at early stage, we only lead early stage rounds. We only lead and we only do early stage. I have a bias towards the stage specialists.
Do you think it's possible for stage specialists like us, the seed specialists, to operate and invest in the hot startups at seed anymore, which are traditionally 5 on 25, 6 on 30, whatever that is? Do you think it's possible for us to build a business around those deals?
I think it's very hard. Yeah. And I think, that's why more often than not, the companies that we invest in are not the star-studded team with that type of round. It's a team that looks a bit more like a Melon Cliff at Canva, but that has a product that's already out in the market, that already has some early signs that it's working, something that's resonating with customers. And so it's typically not in a really hot area like AI at the moment, and it's typically not from a really hot star-studded team.
Huh. Do you think a load of multi-stage funds are burning a ton of money on AI seed companies right now?
Yeah, I think so. I think, we don't think that the foundational model investments that, for example, they're raising hundreds of millions of dollars in a seed, make any sense. They don't make sense for sure for our firm, but we don't think they actually make much sense for the big funds either. I mean, the money is going to fund, CapEx to NVIDIA H100s. It's going straight out the door in many cases. I don't get it. And so I'd love for you to have a bunch of those folks on your show.
I think they declined.
Do you understand it? I mean,
I think the funding rounds are very misreported, and what I mean by that is like there's definitely been some in Europe where $100 million rounds are reported on $250 million valuations. If you actually know, that moronic investors did it on uncapped notes, but actually only 20 was priced at that. And so quite often there's like structure to rounds which journalists just don't get. And actually the founders are not stupid. They're not selling half the company in that round. Investors are stupid for doing it in an uncapped note, and well done to the founders. But one thing that I really want to ask about is, there's a lot of portfolios today where the founders have done riffs and they did preemptive A's in the good times. And so they actually have 8 to 10 years of runway, but they don't have product market fit. I have this in our first fund portfolio. I'm sure many others have it. What happens to these companies with very long runways but no product market fit?
Those companies have to find some product market fit somewhere to deserve to exist for a longer period of time. I think there's a lot of companies that are just having really honest, hard conversations around this right now, or at least there should be. The runway doesn't matter unless it leads to a takeoff or landing, ideally a takeoff in startup land. The other thing is momentum and winning for companies, as I'm sure you've seen, is everything. Like if you do not have that, it is really hard to have a great culture at a company. It's really hard to hire the best people. It's hard to do your best work yourself as a founder. And so you just have to have that at some level.
And it's infectious. I find when things are working, more things work. And and people work harder when it's working because it's fun at work.
Yeah.
Do you know what 100%. I mean?
I think you have to have that. And if you don't have that in a reasonable amount of time, then...
Have you ever had this discussion with founders about returning money? How does that go? And how would you advise me? I've had it too. It doesn't always go great.
It's kind of the conversation that we are just having, which is, do you want to feel like you're winning? Do you want to feel like you have momentum? Because that's what we want you to feel. And invariably the answer is like, yes, we want to feel that way too. And so the question is like, are we banging our head against the wall at the same thing for too long? Should we move on? If so, we can move on and keep the capital. But at some level, I think you have to have that type of conversation.
The question that I have as an investor is like, actually, if generally they will have spent half the money, say, as an average, is it not worth just letting them keep going? They're a team you backed in the first place. They're probably going to meet a certain level of quality, unless it's a real mistake. Actually, the Stuart Butterfield and Slack example always rings true for me. Just keep going.
I think it can be if you're having the right types of honest, transparent conversations around it. And if you're seeing that the team is iterating and experimenting around something and moving quickly around something, like it's okay to throw different ideas at the wall in an experimentative phase when you realize the thing you have that you thought was going to work is not working. I think it's not okay to not be operating with a sense of urgency and to not be able to have transparent conversations around it. And so those are the two things that I would try to suss out and judge.
Yeah, no, I get you. When you think about kind of those early days and actually making the investment decision, I thought of this when we were talking about Canva, but I wanted to kind of let the conversation run. You have people, you have market, you have traction, say. How do you rank them in terms of importance?
I've always been a sort of traction, early signs of product market fit first investor, then people, and then market.
That's really interesting because that's not what people, that's often the opposite. Like you're like an Elag Gill will be like market first and then I think people and then traction.
Yeah. Like I remember having a chat with Keith Raboy about this where he was just like, look, I just look for sort of founder plus keynote. That's my stage. Founder plus presentation plus idea. And I was like, Keith, that I could never do that. I've made very few, if any, investments like that because I like to see the early sparks of something working, and I'm willing to take more risk on the market than I think other investors. And so I'm happy to unpack that if that's...
Yeah, I'd love to understand that and like how that most commonly shows itself. Is it word of mouth? Is it revenue? Like, talk to me about that.
So it's certainly not necessarily revenue, right? As I mentioned with Canva, there was no monetization. Those early signals that you've built something that people love using. And so that can come in the form of, high frequency of usage, or high repeat usage, or high retention, even on a really small base of users. It can come from word of mouth growth, even on a small base. It can come from just anecdotes like, I could not possibly live without this now that I've tried it, from customers.
I find so much in the comments on YouTube videos, on App Store reviews.
Yeah.
I find that a real goldmine of untapped.
Absolutely. Product reviews in general.
Also, like, are people doing tutorials around products? That's a really good one.
Yeah, I mean, you can literally Google and learn a ton about what's happening to a product in the wild without ever speaking to the company. And we always try to do that. And so...
The hard thing is, though, dude, I agree with you totally on all this.
Yeah.
But at the stage we invest, I find they're well past that by that point. Do you know what I mean?
Yeah.
Because that's the A round by the time they've got...
Now, I should be clear about this, which is at Footwork, we only lead rounds. We only do early stage. We lead seeds and A's. So we've made 11 investments so far. We've done 5 Series A's and 6 seeds. I think our average initial check's about $4.5 million, and the range has been $2 to $9 million. We've done sort of later seeds and earlier A's, precisely because we love this stage that I'm talking about, where there is a little something that's working, where the founders can articulate why and have a bunch of unique insights, and where the why now is strong, and where they have a big vision for what it can become. But there may be some level of market risk. It may not be clear how big it can become. We, of course, try to assess that and ask that question over and over again. I wrote recently, this is the question that keeps me up the most. Like, how big can this company be? Can it be one of the ones?
You wrote this in your $1 billion.
Yeah.
Yeah.
That's right.
I remember reading in the research for this. And then I thought instantly we do a show called The Memo where we review the investment decision of multi-billion-dollar companies. And we've had, Jeremy from Snap, Jeremy on Snap, Alfred on Instacart, Byron Dieter on Twilio. The best of the best on the best companies. Every single one said we massively underestimated how big the market would be. Yep. And so I kind of lead back from that thinking it's just a way to come to a wrong decision trying to do market scenario planning.
Well, so a couple of things. One, this is precisely why I underweight market. Does that make sense? Like I weight market third on the 3 that you asked me about, because I just think it's the hardest one to assess and predict for myself. And I think when you look at the investments you just described and some of the very great ones, that was true for those investors as well. You can imagine and dream the dream that the product market fit that this company has, that the team that's building it can expand the market beyond your wildest dreams, can actually create a whole new market. Those are oftentimes the most special companies. And so again, if you think about my thinking around this, it comes back to, well, this is exactly why I underweight market in the analysis.
I always think you've got to be directionally correct. Do you know what I mean? And what I mean by that is like Canva rode a brilliant wave of content creation, of solopreneurship, of marketers within companies, and every company being a brand needing content. There were multiple threads at one time intersection which come together, and that's when you have something really fucking special. I also use it as are we going against the tide? Like if you're going against a certain theme that's just very prevalent, it's a reason to say no, not a reason to say yes. Do you know what I mean?
Yeah, I agree with that.
I totally get you. On the people side, we all make mistakes. When you review people assessment, what have you made a mistake on that you have changed or should have seen?
The first thing that comes to mind, and I apologize that I didn't really look at the questions before coming in here. So
that wasn't on the question.
All of this is unscripted. The first thing that comes to mind though, Harry, is there's this difference between the ability to fundraise and the ability to build a business. And so I have been sucked in and seduced by founders that can tell a great story, that are great in a handful of 1-hour sessions and in person for the first time, who feel like they're magnets for talent, who know their business inside and out, it seems, and who are great at fundraising, and so attract multiple term sheets. And what I've seen happen a handful of times is that they are not good at the fundamentals of building the product and building the team, actually finding product market fit or growing the product market fit that we thought that they had, and that there's that huge difference between fundraising and business building. And I think that's showing up all over the place right now, right? Like there were so many companies that were able to fundraise in 2021 that now don't have P&Ls and fundamentals to show for the vision that they told.
I get you, and I agree that I've definitely fallen victim to that myself, but I'm not sure. And the reason I'm not sure is because you think about founders' ability to sell to investors, to sell to customers, and sell to hires. If you can do those three things, you should have a great founder.
It's not like that is a necessary precondition to failure by any means. But I think it's been a failure mode for me.
Do you sense check yourself on it now? Like sometimes I go, oh, it feels too slick.
Yeah, for sure. Like how much substance is there really beneath the surface? How much does this founder actually care? How much do they really understand? There's a bunch of questions that I try to ask to suss these things out.
What sort of questions do you ask?
Oftentimes if I'm really digging in and really excited about something, I'll say something like, hey, let's just pretend that this is our first board meeting right now, that we just invested in the company. What's the main challenge topic or discussion topic that you want to have in our first board meeting right now? And the spirit of that question is just assessing, like, are they clear-eyed in their thinking right now about what's happening in the business? And can they articulate that? You know, usually you want what they say to be the most important thing that's also on your mind to prioritize and figure out in this phase. And you want some level of sort of just transparency and vulnerability around the answer. But I find that question and the answer you get tells you quite a bit.
Do you know what I find a commonality of the best founders? Often I find, the not so great ones actually will kind of shield themselves. But the really great founders will say, oh, Nikhil, there are so many challenges. Where do we start?
Yes.
We've got 1, 2, 3, 4. And you're like, oh.
Yes. It's very consistent with what I've seen as well. Again, that ability to be confident in what is actually working. But also confident in what's not working yet, and vulnerable about it, and clear-eyed and self-aware about it, is, I think, a characteristic of many of the great ones.
I spoke to one of your friends, actually a mutual friend of ours before the show, speaking of confidence and vulnerability. And they said, the challenge that I have with Nikhil is that he is one of the great ones. He just doesn't believe it yet. And he kind of feels like he should be someone maybe that he has to be sometimes. Do you think that's fair? In
the early days of my career, which I still consider it to be, I mean, I'm 34. I've been in venture for, I guess, 13 years since I started as a summer intern at Insight. There's an insecurity that comes from not yet having delivered in distributions many, many multiples of what I've invested. An insecurity that comes from having started a firm that has so much to prove, everything to prove, an anxiousness that I'll have until we've many times over returned our first fund. But I also think that I know who I am more than I've ever known. I think I'm able to authentically be myself. I think I've sort of been able to find my voice as a writer over the last 3-4 years of trying to do the newsletter as consistently as possible. My hope is that Footwork is an embodiment of sort of who my partner Mike and I are, and that we express ourselves fully, authentically through the investments we make and how we conduct ourselves as a firm.
I was going to ask kind of who you think you are, but it's actually a shit question because no one can actually answer that. But it's like, what actually makes you happy? And it could be anything, but one of my closest friends asked me this the other day, and I said it's 2 things. It's 1, walking around the park with my mum and getting an espresso, ever growing up, Harry. And then 2, it's doing amazing shows or discussions with smart people. Yeah, could be founders, could be investors. That's my 2 things. What just genuinely feeds your soul?
So, I mean, there's 2 that come to mind. The first is I've just always loved those first meetings with founders where I live for the couple every year, hopefully, that just blow me away and that suck me in. And I've had a bunch of those now in my career, but I just love that. And I think as a venture investor, you have to love that thrill. At least I believe in my.
Do you find with those great ones, it's immediately obvious that it's great?
Oh, I've gone back and forth so much on this, right? Because This is
Sometimes
what
there's an
decision making
unlock.
is. Yeah, this is what decision making and judgment is all about. I do think consistent thing for me is, and I've gone back to try to study this, like if I'm thinking about it that evening, if I'm reaching out to people to sort of suss it out better, and I'm just researching on my own about it, hours after the first meeting, there's something there that I should pay attention to. And conversely, if I haven't done anything about it, like 2 days later, that's probably not a fit. And maybe it goes on to be really special, but I actually haven't had that many of those where I didn't really think anything of it. I didn't follow up on any interest in it after a couple of days, and it turned out to be a massive company. And so I certainly reflect a lot on that. And so back to your question, I think it's that thrill that has never escaped me that I hope I have forever. It's the reason why I love this job. It's the reason why I don't even think of it as work, frankly.
Do you and Mike have to agree to get a deal done?
We don't. One of us has to absolutely love the company. The other can like it, not love it, or dislike it. The other can't hate it. And so if you think about the 1 through 4 voting scale, where 1 is strongly unsupportive and 4 is strongly supportive, 3 is supportive and 2 is unsupportive, one of us has to be a 4. One of us has to be strongly supportive to make an investment.
Sure.
And the other cannot be a 1, strongly unsupportive.
I don't know about this. And the reason I don't is because, I think in any situation, I just generally, and I'm speaking because I have a friend who, is bluntly an associate at a different firm, and they kind of have a similar scale. I said, always do a 2. Just always do 2 or a 3, because either one you're like, well, I didn't say no. Unsupportive isn't really and so actually I'm like, no, it should just be 4 and 1.
4 and 1, yeah, fair enough. I mean, I think.
But am I wrong?
I believe that there can be a place in the middle. So for example, I've rarely been a 1 on anything in my venture career, but where I have been, I felt like there's actual downside risk to the firm potentially with making this investment. There's just something really off about it.
Yeah.
And therefore I feel very strongly we shouldn't do it. But I've disliked a lot of companies. I've been a 2 on a lot of stuff where others have been 4s, where I'm really glad that we did it. And conversely, I've been very glad for myself that I've been a 4 and strongly supportive, and other folks have been a 2 because they didn't think it made sense, but they didn't hate it so much that they wanted to block it or say there's no way we should do it. So that's the way I think about it. I think you have to be intellectually honest, obviously, about
in the ones that
system.
You put as 2s that turned out that you were really pleased to have done. What did you not see?
Because of my bias towards companies that have some signs that they're working, some early signs of product market fit, the ones that most stand out there are ones that didn't have that. Where at Shasta, for example, we made a decision to invest in something that was pre-product, but that actually turned out to work. Probably the other ones sort of that I can think of off the top of my head is we stretched on price to do it. And where I liked it, didn't love it, but then I didn't like the price. And so I was netted out as a 2.
Do you find it hard that okay, so you vote 2, you're unsupportive, but you're not there's nothing super, super unsupportive. But then given the size of our teams, you will probably have to work on it quite extensively if you do end up. Dude, 10 years working on a deal, a lot of freaking time on a company you were unsupportive on.
Well, I think for Mike and me, this comes down to just alignment in principles and values that we have, and respect and trust in one another that we have. And so it is very easy for us to disagree, but very seriously commit, because we have a tremendous amount of respect for one another. I think where that would be difficult is if you did not have that type of alignment and trust within a partnership. And so that's what I most think about in decisions like that. For me and Mike, every investment that we make at Footwork is so obviously a Footwork investment. We actually don't even do attribution at the firm. We've never talked about which are Mike's investments versus my investments. We've done some kind of crazy and wacky things.
I mean this in the nicest way. Is that not a bit BS in the way that one person sits on the board and so everyone's like, well, that's Nikhil's or that's Mike's?
Well, look, we actually, for the first year after we invest, both go to all the board meetings together.
Wow.
We both do the work.
Is that not a bit weird? Sorry.
That's what I was about to say. It is weird and wacky and non-traditional. And of course it doesn't scale, but it's been really important for us in the first couple of years of building the firm to operate in this way, because we think that's the purest form of teamwork. Like every venture firm talks about, we work as a team, but very few, I think, actually show up as a team. And we've tried to do that from the earliest days. And so both of us being on the text threads with all of our founders and both of us showing up to those board meetings in year one is reflective of that commitment to actually work together, because we think we have complementary skills that founders can benefit from that. And we really don't want to think about any of the decisions we make as individual decisions.
What are the most dysfunctional breakdowns of investment decision-making processes within partnerships? You see the venture landscape in a unique way, especially given the fact you're not in one of the large firms now.
Yeah.
What are the ways that they break down in terms of decision-making?
Well, look, I think there are partnerships where decisions are made based on the ability of individuals to sell internally. And so there's some folks that are just naturally more gifted to sell the deal to their partners. And there's political points back and forth on, the voting system. And I think that's a terrible way to make decisions. I think there's a lot of stuff that can bleed out from that selling process. I think also in general, it's sort of intellectual dishonesty that unfortunately a lot of partnerships have.
Speaking of kind of the ability to sell internally, it makes me think of Jason Lemkin, who said to me the other day, there's often advice like, don't do a deal for a year when you join somewhere new or you join venture. Yeah. He's like, total bullshit. Like if you have a hot hand, say you come out of a great company and your alumni network is super strong, whatever that is, do deals. How do you feel about the don't do a deal for a year advice that often people get?
Yeah, I mean, look, I come back to the mantra, which is exceptional companies deserve exceptions. So our entire job is to find the companies that are outliers and to invest in those companies. And if you really believe in your bones that something's an outlier, you should be trying to make that investment. So I think it's as simple as that.
Can I ask you, we've spoken about kind of dysfunctions within venture partnerships. Kind of extrapolating that, there's also the LP relationship. Before we talk about kind of dysfunctions there, I know many of your LPs, I'm sure we probably share some. How did you select the LPs that you work with for Footwork?
We had 3 things that we thought about when we raised our first fund, and we actually ranked LPs based on these 3 dimensions. And they were, 1, what's just the quality of the relationship with the people? We really tried to prioritize people who we'd built relationships with, who we really liked as humans, who we wanted around our proverbial dining table as a firm in this first fund. Second, we thought a lot about just, are these people who've seen what world-class looks like, and will they push us to be world-class, which is what we want in our firm. And third, we thought about the mission, values of the institutions themselves, and whether they were institutions that we are really excited to make money for and be partners with. And so those were the 3 dimensions that we prioritized. We assigned like a 1 through 5 rank on each of those. And then at a macro level, we were really lucky in our first fund. We had about $450 million of commitments for a $150 million fund, and we ended up raising $175 million and realized that's incredibly fortunate for a first-time fund. But what we thought about as we were constructing the full LP base was just having a little bit of diversity across both check size and type of LP. And so we wanted, a nice mix of LPs where, there were a few at the $20 to $30 million level out of 175, a bunch at sort of the $10 to $20 million level, a bunch at the $5 to $10 million level. So
20 to 30 is quite a high concentration in a 175 fund. How do you think about concentration limits that you were comfortable with?
We don't have a single LP who's more than 20% of our fund. And I think in general, we thought, we don't want 1, 2, 3 LPs having the majority of our fund and having therefore outsized control in our thinking or our decision making in some way.
And so we have that. And then in terms of like types of LPs, we have obviously there's the corporates, there's pension funds, there's fund of funds, there's high net worth family offices, all the different types. How did you think about that? And do you agree with the common wisdom of, endowment funds, they're so stable? Is that true?
Yeah, so we wanted some diversity, and I think we have about 15 institutional LPs. We have 6 university endowments. I think 3 other foundations. So we're a little bit weighted towards endowments and foundations, but we have a bunch of fund of funds and we have a couple family offices as well. Mm-hmm. And so we like that mix because while the endowments are great names and they are long-term oriented, there's still some level of risk of having an entire endowment-based LP base because they may all sort of have the same denominator effect issues at the same time. They also perhaps tend to be more aligned in what they care about. And so we, in general, like the diversity. And that's what we prioritized.
To what extent are LPs sheep? And what I mean by that, I mean, like, you have some blue chip endowment names that I'm sure we both know, and people generally follow when they do it. Is that true?
Yeah, look, I think that there's, especially in a first fund, there's a handful of LPs around the world, at least that I know of and have met, who are truly independent thinking, who will truly raise their hand and say, we're willing to do a first time fund, and we're willing to be the first commitment or the first big commitment. That group of LPs is very small. It's probably, I don't know, what do you think? Do you think it's 10 LPs, 15?
Yeah.
Something like that, I would say.
There's many actually who'll do it on a spin out. You know, GP from large fund. There's many. But the ones where it's like respectfully not as obvious, I would definitely put mine in that camp. Yours, respectfully, same to you. It's not like, you know, I wrote off both the coming and spinning out.
Absolutely not. So, and our biggest LPs are not LPs in my prior firm. They took a chance without having known Mike and me for a very long period of time. We have a bunch that are LPs from my prior firm, but not, interestingly, the very largest ones.
Can I ask you, a lot of people get the advice of, like, you know, get your anchor first and really solidify the base around that. Do you agree with that?
Well, what we tried to do was we had a bunch of our friends who proactively said to us, we want to commit to invest in the firm. And we went out to a broad group of LPs at the beginning in a first wave, a sort of set of friendly conversations to get feedback on our story, to practice. And we had one institution that we've known for a long time who said, we'd love to do it. They didn't actually say what the check size would be, and it ended up being a small check. But it's really impactful to have one institution that's known you for a while, that's a well-known institution, say yes. And then we did try to prioritize the larger institutions, the sort of group of 10 to 15 that I referenced, that would do a larger check in a first-time fund. Because that's a small N, we just thought that's the right group to see if we can get anyone to do it out of. And we were really lucky that we got a couple of those groups to invest in our first fund.
Yeah. I always think that I find some, they're so focused on getting the anchor, and it's like, I always say, like, get the GPs who they most respect as your LPs, and hopefully they're your friends already. So get them in as friendlies and then leverage them for the intro. And then you can also leverage their check. And so it's like, not only did Nikhil make the intro, he's also investing. It's like, oh, wow.
We had 2 slides in our Fund 1 fundraising deck, which actually, sadly, we barely got to present. We only had it properly designed in February of 2021. And by then we already had the whole fund committed. But in that deck, the last 2 slides are one, board members that we've served alongside, both Mike and me, people who we've literally been in the boardroom with. And that was a subtle way to say, like, here's all the people you can call as references. And you probably know a bunch of these people. And then the next slide after that was, here are all the people who've inbound said that they want to invest in the fund. And that was a bunch of founders that we've worked with, a bunch of GPs that we've worked with at other firms. And honestly, we never asked any of those folks or any individuals if they wanted to invest in Footwork. We just let them say that they wanted to invest. And when they did, we put them on that slide, again, as a way to just have a very easy way to reference us for LPs. And I actually haven't asked our LPs who ended up seeing that deck if those 2 pages resonated. But I suspect that they did, and that they were helpful.
What do you think LPs, you know, we obviously sit in the venture landscape, see a lot more. The transparency VC to VC is very clear, like founder to founder. What do you think we see that LPs do not see in the venture landscape about how VCs operate?
I think that there's a difference in hunger and energy and drive that some managers have that others don't. It's sort of what we look for in the companies that we invest in, right? And so, you know, of course, if you know, it's a manager like you, for example, that really has a unique spin and a unique story and is an N of one on different dimensions, it's sort of easy to see that because you can put it on a page.
It's tangible.
And it can stand
you
out.
can touch it as well.
Yeah, exactly. It's like, oh, it's sector focused in this area and I believe in that area. Great. It's like super easy to check the boxes on some funds like that. And don't get me wrong, there's incredible funds that are like that, right? But I think a lot of this business is the human side. And I don't think that that's going to change. Assessing a person, individual GPs, real commitment to doing this, their level of drive and hunger, their ability, of course, to improve themselves and learn, their ability to source and to make investment decisions and to win and help companies. It's actually hard to get to the bottom of that, just as it is hard to get to the bottom of really how great a founder is for us in our jobs as VCs.
And so you think LPs don't do that well?
I don't think that they spend enough cycles on it. But I actually think some of the great ones do. And of course, I'm biased here. You know, we had LPs who did, I don't know, 30, 40 references that we heard about on us each. You know, we were heavily scrutinized on us as people because so much of our strategy is really just about the two of us, Mike and me, and our ability to make decisions in the partnership that we have. That's where we found LP GP fit with our LPs, is the folks who really dug in on us as people and how we make decisions and who ended up fortunately supporting us.
You mentioned picking, it was seeing, picking, winning, helping and exiting. If you were to say your best and your worst, what would you say? My
worst right now that I feel is on the sourcing side. You know, I think when you're a duo investing at seed and A as a generalist firm, it's impossible to see everything you want to see.
Yeah.
I think it's hard too when you have started a firm and you have other responsibilities to be able to purely focus on sourcing companies.
Sure.
We do calendar audits and Catherine and Rachel, who are our operations folks at Footwork, actually send both Mike and me every week. What does our calendar audit look like for this week that's just passed, and what does it look like for the upcoming week? And the single metric that we're focused on there is, are we spending more than 50% of our time on meeting new companies and sourcing new investments? I firmly believe you have to spend the majority of your time on those things to be able to find the next great one. And the beauty of our business is the next one can be the one, right? The next one can be the one that changes everything and the trajectory of the firm.
So are you going to peel off boards? Because you're not going to be able to keep that ratio.
Yeah, and so that's certainly something we're going to have to figure out. And there's lots of things we're going to have to do to figure out how to scale this firm. But again, I would say sourcing is where I feel weakest at the moment. I think conversely, on the helping side, I feel like while we don't talk about the great platform that we have and we don't have a bunch of people that support our companies, Mike and I really do the work. And we try to really be there for the founders that we work with. I do think it's at a different level from others. And I think when you only make a handful of investments every year, when each one really matters to you because you're leading those rounds, you can deliver that type of really personalized support. And that's so much of why we've built this firm. And I do feel really great about that dimension. And I think you would find it in the references you do with our founders, which to me is one of the most important metrics.
Do you buy the platform value add services generation that we saw?
Look, I think there's a handful of firms that have done it well, but every firm getting a head of talent and
well, it's just also, if we just break down a head of talent more, like there's a great example, but like if you're hiring a head of developer relations and a company where it comes to a head of talent, that is a fundamentally different hire to a CMO. What you need to be able to discern between, they are not going to be the same. They're not going to be the same network. So at the end of the day, they're writing a JD and working the process with a firm. It's not that great.
No, and it's a muscle that the great companies build themselves.
Yeah.
And so there are a handful of firms that have platform offerings that have moved the needle. But most of those platform offerings are about scaling the firm themselves versus about actually scaling companies and really helping companies get to the next level. That's certainly my firm belief.
Can I ask you one more before we do a quick fire? I think you learn a lot from your biggest hits and your biggest misses. When you think about that, what would you say is your biggest hit other than Canva, which you shared about? What would you say is your biggest hit? And how did that change your mindset on what good investing is?
I actually think my biggest hit right now, at least as I can best predict it, is not Canva. Dollar gains perspective and on an IRR basis as well, it's a company called The Farmer's Dog, which is in the pet food space. And it's a subscription service for fresh pet food. It's doing fabulously well. And I love it because not many people know about it. And
I
how
do.
well
I
it's
invest in a UK alternative. It was a tough business.
And so it's two things. First, that some of the best businesses are incredibly simple. And they're simple to understand. They're actually simple to build, but they're based on unique insights. And I think that that's going to be the story of The Farmer's Dog once the story fully gets out. And the second is the pet category is a fabulous category. And there are some markets where the tailwinds are just so strong in multiple different ways that there's a lot of opportunity for incredible enterprise value. And I think that that's the case for The Farmer's Dog.
So, okay, that's the winner. What about a miss, and what did you learn from that?
The first one that comes to mind that I've reflected on a few times over the last year is Figma. I spent time with Dylan Field in the very early days. I was actually one of the early interviewers for the Teal Fellowship program, which he was in. And I remember going on walks with him in Palo Alto, and a little bit like you, actually, he was mature for his age. Now, I'm trying to think back to our first meetings in San Francisco and London. You were mature in certain ways. You were immature in other ways. But Dylan was really mature in a bunch of different ways. Like the way he was thinking about the need for perfecting the product before getting it out there, the opportunity to go after Sketch and others that were in that market already, but also just on life-related stuff. Like I remember asking me about my relationship with my then girlfriend, now wife, how we make decisions together and how we communicate and what's good about our communication, what's poor in our communication, all sorts of stuff like that, where I think he was about 20 years old at the time, maybe even younger than that. I don't think I've still seen anyone at that age be able to think about those things in sort of work and personal life at the level that he was thinking about. I've reflected on that a bunch of times because I wish I could have been in both Canva and Figma.
Why did you not?
This comes back to my bias around wanting to see some early signs of product market fit before investing. And Figma did not have a launched product before its first couple venture rounds. Yeah. So I give the folks that did those rounds, I think John Lilly at Greylock and Danny Reimer at Index, if I'm not mistaken, I give them a ton of credit because they saw the specialness, I think, in Dylan and in that market opportunity.
And were willing to wait, because there were a couple of years where it was like, when's he actually going to release something?
They were willing to do it and then be patient enough. And I think there are multiple rounds. I think I talked to John Lilly at Greylock about this. Multiple rounds that John was involved in before the product even launched, which is incredible. Yeah. And so hats off to Dylan and hats off to those early backers.
You said about your wonderful partner. I do have to touch on fatherhood. Yeah. It's such a special but also significant change to life. There's so many ways I can take it. I think the biggest one that I'd love to understand is if you could advise yourself one thing and call yourself up the night before your wife gave birth, what would you tell yourself?
Oh, man. Well, first I would say go to the airport sooner than you think. Our daughter was born less than 30 minutes after we left the house. Fortunately, we live less than 5 minutes from UCSF in San Francisco, but that was the craziest 30 minutes of all of our lives. And fortunately, it was incredible. And my wife is a total hero and champion. But on a more serious note, what I think I would advise myself is you think you have a bunch of control over your life, and you kind of do have a bunch of control over your life right now, but tomorrow you suddenly are not going to have a bunch of control over your life. Like all these things are going to be out of your control as a parent. You can't control exactly who your kid is. You can't control how they're going to behave in certain places and dimensions of life. You think you have the perfect childcare set up, but stuff's going to go wrong. You're going to have to keep adjusting your schedule. And so you sort of have to embrace the lack of control and the surprise that is going to come from all of this experience. And I think the joy of parenthood is in the randomness and surprises of it. And so it's still something that I'm comprehending, but
was that challenging to you? You're a very structured person. It's challenging
Yeah.
to embrace randomness and spontaneity and change your plans.
Absolutely. And yet it's an incredible gift too. We all get to live this life once. And so having that has been one of the great joys of having a kid.
How does it change your relationship with your wife?
Yeah, it certainly makes things harder on a bunch of dimensions. The cliche thing that people say, which is you just have less time for each other, is absolutely true. But I also think it gives us purpose. Like we have this unified person who we're thinking about and sort of co-parenting and co-working on. It's also strengthened our partnership in a lot of different ways. And it's given clarity to kind of what matters.
Do you think it changes the type of investor you are, companies you like to invest in, way you like to operate as an investor?
It does, in the sense that my time obviously matters more than ever. And I think that's only gonna continue being the case in my life. And so I have to believe in my bones when we make an investment decision that this is something I really want to spend time on. Perhaps it used to be much more just about the capital and the economics. And now it's about both that and time, because time is such a precious commodity. So again, that's the first thing that strikes me.
Can I ask you, I have a lot of conversations with people about this, and they say, I actually wish I'd had children sooner. They say that post, do you wish you'd had children sooner?
I don't think so. I think I was 32 when we had our daughter Shreya, and I got a lot done in my 20s. Got a lot done in we raised.
Can you work as hard as a parent? Like, this is what I worry about.
Yeah.
I worry that you're able to. You know me now pretty well. I just pounded at my desk a lot.
Yeah.
You can't do that when you're a parent.
No, and I believe the answer is no. I mean, it has not been the case for me. I want to preserve that window, for example, from 5:30 to 7:30 p.m. every day that I can, because that's a really special window to do dinner time, bath, bedtime. I also spend time with her in the mornings because my wife works starting pretty early, East Coast hours. So I'm typically the one who takes our daughter to Montessori in the mornings. It just means that I have to spend my 7:30 to 10 p.m. window working every day. That's the only way I've found to be able to make up for some of those lost hours on work. Now, the flip side is I think I have to be present in those windows with her. So I hope that it does something better for my brain when I'm actually focusing on work, that I can be slightly more efficient. But I was also pretty efficient before. So I think overall, I am less productive.
Good. Well, I'm glad it's not just my worries.
Yeah. Sorry to tell you that.
I want to do a quick fire round, my friend. So I say a short statement, you give me your immediate thoughts. Does that sound okay?
Okay.
So what have you changed your mind on in the last 12 months?
AI as being a very, very interesting category. I honestly don't know if there's great AI first opportunities for us at Footwork to invest in. And that's because of just the insane hype cycle around it at the moment.
Do you not think, so that's too good a one for me not to get on. Do you not think though that bluntly, people always overestimate adoption cycles and underestimate like long-term value adoption?
Yeah, I think that's right. I think
so. For us, I think there absolutely will be amazing opportunities, but we don't have to shoot the fund out in 12 months on it. It could be 3, 4, 5 years out. Yeah,
and I just think we over-rotated once again very, very quickly towards excitement here. And again, I'll admit at the very beginning of playing around with ChatGPT and other products, Midjourney, I was very excited, just like everyone else. But as I've thought through the venture investments here, I don't think that there's a lot of AI first, AI enabled companies that are going to be for us in this phase. And yet I do believe
because they're too expensive. Too expensive,
and there's just so much competitive noise. And there's also so much that I think, for example, in the large language model world, that the LLMs themselves will serve as a use case versus an application layer on top of those LLMs. So for example, I've heard there are several companies now that have grown rapidly in ARR and have now started declining in ARR as retention actually starts to affect these businesses, because there's churn from folks who just try out products built on top of these LLMs because they're interested in the novelty of them. But then, churn away. And there's also just the reality that as ChatGPT itself gets better in leveraging GPT-4 and other models as an example, it serves those use cases that some of the application layers on top of ChatGPT and GPT-4 have tried to serve.
Well, I think people are forgetting novelty enterprise buying, which is like there's a lot of AI companies there. So you have Walmart, McDonald's, Porsche, and it's like, you know, 2 people in their design team testing it out with the 10K.
Yes.
And that is not the same as enterprise-wide rollouts. Okay, what would you most like to change about the world of venture?
People talking about AUM as a metric. I think AUM is the stupidest thing to talk about as a venture firm, because back to what we were talking about earlier, small funds outperform larger funds. And so you really shouldn't be talking about how much capital you've raised. I'm okay with people talking about how much capital they've returned and how much enterprise value they've created. But I just think talking about the aggregate size of all the funds that you've raised is a complete vanity metric.
I think the enterprise value of like portfolio companies is total bullshit though too, because it's like I could invest in, you know, Figma in the Series E.
Fair enough.
And then it's like we've created $35 billion, and you're like, come on, you put in 500K in D. I've seen some. Do you know what I mean? Though?
Well, yeah, I
totally agree with you.
I think dollars returned.
Yeah.
That's the thing that matters the most.
What was your biggest investing mistake between 2020 and 22 in the hype cycle?
I think it was doing our pro rata in companies that quickly raised another round at a huge step up from where we first invested. Fundamentally, there was very little de-risked. And we saw this happen where a company had raised a Series A from us and 2 months later, they did a series. This is a real example. 2 months later, they did a Series B at a 7x, 6 to 7x markup. And that becomes a very big position for you without that much being de-risked from the initial round. And
do you do reserves now?
We do, yeah. But
why?
A couple of things. One is obviously there's going to be some cases where an entrepreneur is going to need a little bit of extra support to get to the next round. And you know, of course, some of those may not be the right decision to make, but some of those I do think will be. The other thing is that I think in a world where...
Have you had bridges that lead anywhere?
I've had a couple in my career, yeah. Obviously, it's too early to tell at Footwork. I think the other reason is, especially as a newer firm, you want to be able to say that we can support the company in that next round. I do think there's validity to that in especially today's market where capital isn't as free, where folks who are leading the next round may be looking at whether the insiders are going to do their pro rata or not as a signal. And so we like to do our pro rata on the next round following ours, and then we pair back. If you think about our total fund, I know I'm answering your quickfire question longer, but our total fund size is about 175 million, right? We think we'll make about 20 investments out of that fund, average check of $4 to $5 million. So let's call it sort of $80 to $100 million on initial investments, and the rest is for follow-ons.
So you got like still 30 to 40 for follow-on. That's
right. So it's still... and well, hopefully we have recycling as well, but it's still weighted towards initial checks. But we do think there's value in having a little bit reserved.
I just feel that reserves actually fundamentally are challenging dollars to deploy because you'll most often do it according to traction.
Yeah.
And I look at mine and like some of the fastest spikes are not the sustainable value creating companies. Do you see what I mean?
Yeah, it's fair.
Logically, you would concentrate capital towards those. They are absolute bangers in the moment.
Yeah. Look, it's where we started our this particular conversation, which is the decisions that I regret in that 2020 to 22 era were those pro rata decisions, and I think we've got to be a lot more disciplined on those moving forward.
Which less well-known firm do you most respect?
I'll name 2. I think USV doesn't get the credit that it deserves. I think it should be in that pantheon of greatness that sort of Sequoia and Benchmark are typically put in.
Do you think that's just being on the East Coast?
I think so. Yeah. And I think it's because I'll never forget, for example, when Coinbase went public, every investor was on CNBC or wrote a blog post about it, whether they were on the board or, you know, just a tiny investor in the company or whatever relationship they had.
Or a user.
Or a user, exactly. And yet you heard absolutely nothing from Fred Wilson on that day. Absolutely nothing from USV on that day.
From the guy who writes a daily blog, it's great.
From the guy who writes a daily blog, from the person in the firm that led the Series A round, you heard absolutely nothing. And I was just...
Same with Mickey Malka.
There you go. Same with Mickey. But I was just so floored by that. And I just loved it. And so I just respect the hell out of those guys. And I do think They are one of the most collaborative and team-based firms, if not the most out there, which is, as you know, a North Star for Mike and me at Footwork. I'll say USV, but of course they are well known. I'll say another that I think is less well known, which is IA Ventures. And
I was going to say IA.
Yeah, Jesse Beirudi, who's one of the two GPs now with Brad at IA, was a fellow intern with me at Insight. And so we've known each other since we were 20 years old. And he's just incredibly thoughtful. And the thing I love about them is very few people know about them. They do very little on the external brand front, but they have crushed it. And I think they know what they are good at.
They know what is their type of deal as well.
Yes, they know their
way
taste.
That I think you know, actually.
Yeah, they know their taste, and they have great taste. Yeah. And they've kept discipline on everything. And as you know, they have done fabulously well from a return standpoint.
Roger is now retired.
Exactly. And you could see the data, I think, from...
You know when a fund's done well, when the manager then returns with, I'm managing my own money now, you're like, well done. Best board member you've sat on a board with, and why them?
I'll put one that I miss right now working with, which is Vas Nadarajan at Excel. Vas and I were also at Insight together in the summer 2010. He left soon thereafter to join Excel, so he's been there, I think, for about 12, 13 years now. He led the seed round in Frame.io, where we did the Series A with them at Shasta. And so I got to work with Vas and founder Emery and the team there. You know, I picked Vas because I think he's not that well known, but he's got a great portfolio. Frame.io was acquired by Adobe for $1.3 billion a couple of years ago. As an example of that, a Segment was another one that he did. But as a board member, he just asks really thoughtful questions. He sticks to just what's most important to prioritize as a company. And in my peer group, in sort of our generation, although you're younger than me and I'm younger than Vas, I still think of us as sort of the same generation. I think he's one of the best and probably hasn't gotten the credit he yet deserves for that.
No, I totally agree. I think he's fantastic. You can have dinner with anyone, dead or alive. Who do you choose?
Two of my heroes wrote a book together, and so they have a ton of chemistry, and that's Sir Alex Ferguson, the longtime manager of Manchester United, and Sir Michael Moritz, the longtime partner at Sequoia. And I think what would be special about dinner with both of them, I've actually had dinner with Sir Michael, but sadly I've never met Sir Alex. I think what would be special about dinner with both of them is the chemistry that they would have in that dinner. The fact that they are my two heroes and two of my favorite subjects would make that so much fun.
Final one. Footwork in 5 years' time or 10 years' time, you can choose. But you said AUM's not the metric we should be measuring. Most firms always scale. What does Footwork look like in the 10-year frame?
Yeah. We perhaps add one or two equal general partners to our group who are refounders and co-owners of the firm with Mike and me. But most importantly, we've been able to already work with a handful of really special founders and companies where we've been their lead Series A or seed partner. Again, that probably in 5 to 10 years is not going to show up with distributions and DPI, but hopefully it shows up in just the fundamental nature of a couple of the companies that we work with and their scale and revenue, their business fundamentals, the impact that they're having on markets and on hopefully creating categories. And so, Mike got to work with a woman named Katrina Lake, the founder at Stitch Fix, from 5 people to 10,000 people and from zero revenue to a couple billion in revenue. And we hope that we get to work with a handful of Katrinas, of Melanie Perkins from Canvas, of Jonathan Regas from the Founders Dogs. We hope to work with a handful of those folks over the next 10 years.
Nikhil, I've loved this. It's so much nicer to do it in person. I've so enjoyed this chat. So thank you so much for joining me.
This is awesome, man. Thanks for having me.